Welcome to the Value Vault, separating headlines from high stakes. Opportunity may be knocking.
On this deep dive, we're really plunging into a stack of insights. We're covering, well, everything from the big picture in markets and policy right down to the accelerating, potentially game-changing impact of AI and robotics.
That's right.
We'll unpack what some really sharp minds are seeing out there, where they think these forces are pushing things, and, what that whole landscape might mean for you as you navigate your own decisions.
Yeah, absolutely. The sources we've pulled together, they offer a pretty comprehensive view, I think, tying together those big macro trends, specific investment strategies, geopolitical shifts, and then that ground-level disruption happening with artificial intelligence.
Right.
It's really about connecting the dots, isn't it, between these areas that might seem separate, just to build a clearer picture. And connecting those dots is so key, especially when, the headlines can feel so contradictory day to day. So let's jump in. In today's Macro Minute, based on the analysis from 42 Macro, there's a core question they're wrestling with right now, isn't there?
Mm-hmm.
Are asset markets kind of sleepwalking into a turbulent summer?
That is precisely the starting point they lay out.
Yeah.
They acknowledge that, yes, there is the potential for volatility, maybe some turbulence over the summer months, for sure.
Right.
But, and this is really their critical point, as long as their highest probability outcome, which they label paradigm C, as long as that remains the dominant force, investors need to stick to a very specific, quite disciplined strategy. Buy the dip.
Buy the dip.
Okay.
Even if things get rough. I mean, that seems a bit counterintuitive if you're expecting turbulence.
It does, yeah, if you're just looking at the surface level. But they frame this paradigm C thing as understanding the forest, right? Not getting fixated on every single little tree.
Officers, not the trees.
Yeah.
Okay.
And the forest here is the overall trajectory of the economy and policy outcomes. They see it driven by the administration's incentives, particularly with, the 2026 midterms kind of looming on the horizon.
The political timeline.
Exactly. Their view is that there just isn't enough time, really, for a significant pivot towards a more bearish paradigm B, one that would involve serious austerity or a sustained anti-growth stance. There isn't time for that to take hold and really impact the economy in a meaningful way before that political deadline hits.
So the politics are kind of dictating the economic possibilities in their view. What about those trees, then, the individual distractions you mentioned?
They explicitly call those scarecrows. Things like specific tariff announcements or the political back and forth you see in Congress around complicated legislation. They even mention a sort of hypothetical one big ugly bill act just to illustrate the kind of brinksmanship that can cause noise.
Right, the headline drama.
Yeah. And their advice is crystal clear. These should be treated as temporary distractions, things you need to fade, basically, or look past over the medium term, even if they do trigger some short-term volatility this summer. Don't let the scarecrows spook you out of the forest.
Don't let the political noise or, specific trade headlines distract you from the bigger picture they're calling paradigm C. So what's the market prediction that flows directly from that perspective?
Well, their high probability prediction is that the next 20% move in the U.S. stock market will be higher. Now, they are very upfront about this. It doesn't mean a straight line up, not at all.
Okay, important caveat.
Very important. They acknowledge the distinct possibility, maybe even likelihood, of a 10% move lower first. But the core investment advice holds. If you see a dip of that size, or even smaller ones, you should buy the dip, because the probability, in their view, remains skewed towards a significant upward move happening eventually. Unless, and this is key, unless and until they officially dismiss paradigm C as the most likely outcome.
Wow, that takes some serious conviction, doesn't it?
Yeah.
To look at a potential 10% drop and see it as a buying opportunity based purely on that longer-term view.
It absolutely does. And you can see that conviction embedded in their approach to portfolio construction, which they sum up with the acronym KISS. Keep it simple. Stupid.
KISS. Okay, what does that look like?
Their target allocations are pretty straightforward.
Yeah.
30% cash, 30% stocks, 30% gold, and 10% Bitcoin. And they actually share that currently, their actual exposure to gold and Bitcoin is at 100% of those target allocations.
Oh, interesting. So fully allocated in those two.
Right. Which indicates their signals remain strongly bullish specifically for those assets, even within that broader bullish paradigm C framework.
So they're not just saying buy the dip generically. They've got specific portfolio positioning that reflects high conviction in certain areas. What's the philosophy behind this KISS approach? It sounds like it's explicitly not about jumping in and out, not active trading.
Precisely. They really emphasize that their framework is fundamentally about risk management. It's not about constant trading or reacting nervously to every single news headline. Their foundational view is that an investor's default setting should actually be to be fully invested.
Fully invested by default.
Yeah. The only justification for not being fully invested is if a clear, defined risk management signal from their own framework tells them otherwise. So basically, you stay invested unless your system specifically tells you to get out, rather than trying to time every little up and down.
That really turns the conventional wisdom on its head for a lot of people, I think. Many feel safer holding cash by default.
Okay.
And they have some pretty strong words for those who constantly preach caution or, doom and gloom.
They are quite blunt about it, yes. They're very critical of what they call bear porn, that constant fear-mongering you see in parts of the financial media and among some analysts.
They're porn, okay.
They argue that a lot of this is intentionally designed to prey on our behavioral biases, particularly something called myopic loss aversion.
Myopic loss aversion.
Yeah, it's that deeply ingrained human tendency we have to feel the pain of a short-term loss much, much more acutely than we feel the pleasure of an equivalent long-term gain.
Right, losses loom larger.
Exactly. And while that bias might have been useful for survival, thousands of years ago, they argue it's actively harmful to long-term investing success today. They actually suggest that many in their industry exploit this fear by constantly telling people to be scared and stay out of the market. They find it, frankly, unethical because it prioritizes the analyst's business model, you know, getting subscriptions based on fear over the investor's actual financial well-being.
Wow, that's a strong accusation that fear is basically being weaponized for profit. So, okay, for the listener, how can understanding this paradigm C framework and this idea of fading the scarecrows, how can that be important for your investment decisions?
Well, it gives you a lens, right? A filter through which to process information. When you see a headline about tariffs or some political squabble causing market jitters, this framework encourages you to step back and ask, is this a fundamental shift in the forest? Or is it just a temporary scarecrow that the market will likely look past over the medium term? It helps you try to distinguish signal from noise and hopefully avoid making rash decisions driven by that short-term fear.
And the other piece, how can understanding these behavioral biases, like myopic loss aversion, help you avoid those common investing mistakes?
I think simply being aware of it is a huge first step. When you feel that instinctive urge to panic and sell during a market dip, you can pause and recognize, okay, this might just be my myopic loss aversion kicking in.
Right, naming it.
Exactly. Then you can ask yourself, have the fundamentals or the paradigm actually changed? Or am I just reacting emotionally to short-term price movements driven by fear? Recognizing that bias can empower you to stick to a more disciplined strategy, like buying the dip within a bullish framework, if that's what's appropriate according to your plan.
It's really a call for emotional discipline, isn't it?
Yeah.
And focusing on that bigger picture to counteract those primal fears. All right, let's shift gears a bit. From the overall macro strategy, let's look at recent market performance and maybe who seems to be driving it. Pulling insights now from Anthony Pompliano.
Yes, Pop starts by highlighting just how strong the stock market has actually been recently, which, almost feels counterintuitive given some of that pervasive fear we were just talking about.
He points to a specific statistic about May, right? A really standout month.
He does. He notes that the S&P 500 just experienced its single best performance for the month of May in 35 years. That's a pretty significant data point, especially when you think about the backdrop of, lingering economic anxieties or geopolitical worries.
Best May in 35 years.
Yeah.
Yeah, that definitely jumps out. And he follows that up with an even more striking statistic, I think, from Ryan Dietrich regarding future performance after such a strong May.
Yeah, this is where it gets really interesting. He shares data showing that when the S&P 500 has gained more than 5% in May, which is exactly what happened this year, the index has never been lower over the following 12 months.
Never lower.
Never lower. And the average gain in those instances has been nearly 20%. He really emphasizes that no other month on the calendar shows a better track record of future performance after posting a 5% or greater gain.
Never lower in the next 12 months after a strong May like that. I mean, historical data is never a guarantee, obviously, but that's a remarkably consistent pattern. And this recent market strength, it seems to be tied to an interesting split in investor behavior.
It absolutely is. Pompliano details what he calls the Wall Street versus Main Street divergence. He presents some pretty clear evidence that Main Street investors, meaning, retail individual investors, they've been pouring capital into the market at a historically high pace.
Okay.
He cites figures showing $122 billion in equity ETF net inflows year to date just for retail. And this apparently accelerated dramatically since mid-March, with retail inflows actually doubling during a period where some might expected them to pull back because of volatility. Retail investors, he notes, have been net sellers in only 6 trading sessions since March 1st.
Only 6 days of selling since March. So Main Street is aggressively buying the market. What are the professionals Wall Street doing in contrast?
It's a stark contrast. Institutional and professional investors have actually been withdrawing capital. They've seen $25 billion in withdrawals year to date. Pompliano interprets this as professionals either sitting on the sidelines, maybe waiting for a dip that hasn't really materialized in a big way, or actively selling into the strength that this retail buying is creating.
And the retail investors, who are often, caricatured as less sophisticated or the dumb money, they're actually succeeding with this strategy, making money.
According to the data he presents, yes, they are. He quotes global market investors showing that retail investors have effectively bought every single dip this year. And the key result, the S&P 500 has returned an average of about 0.36% on days following a down day. That's apparently the highest average return ever recorded following a down day.
Wow.
He explicitly mentions that retail investors have purchased over $50 billion in U.S. equities just since the low point back in April.
Profiting consistently just by buying every dip. How does he explain this apparent success of, decentralized retail action? It's not like they're coordinating in a room somewhere.
No, he sees it as collective action happening in a decentralized manner. These individual investors acting independently, but perhaps, sharing information and sentiment online, have kind of coalesced around one simple core mentality: buy the dip. And their combined buying power, which has been persistent even through minor sell-offs, is effectively setting the market's direction and rewarding that very behavior. He says, the market is the ultimate referee, and in this environment, it really seems like retail is more than holding its own against the pros.
It's fascinating, isn't it, to see Main Street potentially leading Wall Street in terms of successful positioning this year. And he connects this market dynamic back to broader government policy, too.
He does. He points to what he sees as a noticeable shift in economic policy coming out of Washington, D.C. It's a shift towards prioritizing growth, leaning into increased government spending, and coupled with things like effectively removing the debt ceiling as a real constraint.
Okay.
He views these policies as fundamentally creating a bullish environment for liquid assets like stocks and Bitcoin, essentially providing a policy tailwind for the very assets that retail investors seem to be favoring.
So the policy environment is aligning with the assets retail is buying. That makes sense. So for a listener, maybe reflecting, are you part of this Main Street phenomenon of consistently buying dips this year?
Yeah, it's definitely worth reflecting on your own investment approach. Have you been adding to positions on down days? And how does seeing this, documented divergence between retail success and institutional withdrawal, how did that influence your own strategy? Does it reinforce what you're doing or maybe make you question what the professionals might be missing?
That divergence is definitely something to ponder, for sure.
Okay.
Moving from market behavior and policy to a force that Pompliano also highlights as being profoundly underestimated: AI and robotics.
Yes, he pivots here to argue that the sheer scale, the disruptive potential of AI and robotics, it's just being severely underestimated by the vast majority of people. He frames it not just as some niche tech trend, but as something that will fundamentally reshape daily life and the economy.
And he brings in some heavy hitters to back up that assessment of scale, like Mark Andreessen's prediction.
Right. He shares Andrew Ressen's view, apparently from a conversation with Joe Lonsdale, that we are heading towards a future with hundreds of billions of robots.
Hundreds of billions.
Hundreds of billions, existing in all shapes and sizes, performing just an incredible variety of tasks. That number, hundreds of billions, it's almost impossible to really wrap your head around, isn't it? It suggests a level of integration far, far beyond just, robots in factories.
Hundreds of billions of robots.
Yeah, that paints a picture of a world dramatically different from today. He uses a concrete, real-world example, though, to show this isn't just sci-fi. It's already happening at scale, right? The Waymo self-driving cars in Phoenix.
Exactly. He points to the widespread adoption and success of Waymo's autonomous ride-hailing service there. And his key takeaway isn't just that the technology works, but that in a competitive, free market environment, consumers are actively choosing the robotic option.
They prefer it. They're opting for Waymo cars at a pace that suggests this could eventually eclipse human-driven ride services. Whether the reasons are, safety, cleanliness, maybe just convenience, the fact that consumers are choosing it is a powerful signal of demand for these robotic services and their viability.
Consumer preference driving adoption. That's a real-time experiment proving the concept at scale. He also brings in David Friedberg from the All In podcast for his perspective on AI's economic impact.
Yeah, and Friedberg's take focuses heavily on the potential for massive deflation. He believes the productivity gains and the cost reductions driven by this AI revolution could potentially cut the cost of everything by half.
Cut the cost of living by half. Wow, that's a staggering thought with huge societal implications.
It really is. And he extrapolates this potential deflation to predict fundamental shifts in work and leisure. If costs drop that dramatically, maybe people only need to work around 30 hours a week to maintain a lifestyle equivalent to or even better than what they have today. This would free up vast amounts of human time, right? Leading to more time for family, friends, hobbies, leisure. He draws a kind of historical parallel to the shift from a predominantly agrarian society, where most people were farmers, which freed up labor for industrialization and eventually led to more leisure time compared to previous eras. He sees AI enabling a similar, maybe even more profound shift away from our current labor structures.
So AI isn't just an efficiency tool in this view. It's potentially a pathway to widespread abundance and more human time outside of traditional work. Okay, so for the listener thinking about this, how might the scale and disruption of AI and robotics and this potential for massive deflation, how might that impact your job, your daily life, or even your long-term financial planning?
It really forces you to think about the future of work, doesn't it? And the value of your skills. If tasks are being automated at this kind of scale, what skills are uniquely human and will remain in demand? And from a financial angle, if goods and services actually become significantly cheaper, what does that mean for your savings, your spending habits, your investment goals, even retirement planning? Is the potential for deflation something you have factored into your financial outlook at all?
It's a truly disruptive force with implications that touch almost every aspect of life. Now, speaking of economic impacts and policy again, Pompliano also covers recent comments from Treasury Secretary Scott Bessent.
Right. He includes Bessent's views, specifically noting they address some of those ongoing anxieties about inflation and the potential impacts of tariffs.
What's Bessent's core message regarding those concerns? Is he worried?
He seems to be pushing back against the idea that current policies are driving significant price increases. He contends there have been, quote, no price increases thus far in the way some people fear. He highlights recent inflation numbers actually showing a drop, specifically the first drop in 4 years, which he frames as unambiguously pro-consumer.
And how does he support that argument, beyond the headline numbers?
He encourages people to look beyond just abstract data and listen to what major retailers he names, Walmart, Best Buy, Target, Home Depot, Amazon, what they're actually saying on their earnings calls. The implication is that their reports don't show runaway price increases or consumer distress from inflation.
Okay. And on the tariff front, that's another big concern for many.
Yeah, on tariffs, he cites a South China Morning Post report suggesting that a significant portion, maybe 65% of the cost of recent tariffs, is likely being absorbed by producers in China. This counters that common fear that tariffs will inevitably lead to less inventory or higher prices for American consumers.
That challenges the assumption that the importer always pays. Interesting. What's Bessent's broader philosophical takeaway from all this?
He basically concludes by advocating for a wait-and-see approach rather than constantly projecting potential negative outcomes. His quote is, people should stop trying to say this could happen and let's wait and see what does happen. Focus on the realized data, the observed outcomes.
Let's wait and see what does happen. Focus on evidence over speculation. Okay? How does Pompliano connect Bessent's perspective on inflation and tariffs back to that investment thesis we discussed earlier? Especially that provocative idea of savers or losers, investors or winners.
He argues that, look, trying to predict or stress about short-term fluctuations in interest rates or inflation, while they get a ton of media attention, often don't matter as much for investors when you face these larger, more fundamental forces. The key understanding, in his view, is the continued reality of currency debasement and the persistent rise in national debt.
Right, those underlying currents.
Because of that underlying dynamic, the government is structurally incentivized, maybe even essentially compelled to prevent any sort of prolonged deep bear market in risk assets. A significant sustained economic downturn would just be fiscally devastating given the current debt load.
So the sheer need to manage the national debt creates a political and economic imperative to support markets, keep things afloat.
Exactly. And this creates a persistent underlying tailwind for risk assets. So when you combine that ongoing currency debasement, cash losing value over time, with this need to support asset prices, the simple, maybe blunt outcome in his framing is that savers are losers, investors are winners. Holding cash sees its purchasing power erode, while investing in assets like stocks, gold, Bitcoin, which can potentially benefit from this environment, is rewarded over time.
Savers are losers, investors are winners. That's a really provocative statement, isn't it? Flies in the face of traditional financial advice for many. So for the listener, how does the Treasury Secretary's perspective on inflation and tariffs align with, or maybe differ from, what you are seeing in your own life and the economy around you?
Yeah, are you personally experiencing the kind of runaway price increases that some fear? Or does the data on dropping inflation maybe resonate more with your reality? And how does this powerful, stark idea of savers are losers, investors are winners sit with your own financial situation and your long-term goals? Does understanding the debasement argument and the government's incentive to support asset prices, does that change how you think about saving versus investing?
It certainly gives you pause, makes you consider the long-term implications of fiscal policy on personal finance. Definitely. Now let's shift gears again, moving to a look at more global dynamics, particularly around defense spending, drawing insights now from Rob Powell's Real Vision.
Yes. Real Vision delves into something they've been tracking for a while, the defense spending trade, or what they sometimes call the Randall trade.
The Randall trade, right? They're a specific term for tracking investments related to increased defense spending. How's that trade performing lately?
They note that it's actually been doing quite well recently. However, they do add a caveat. It seems to involve a significant number of retail investors, which, in their experience, can sometimes make a particular trade prone to sharp, maybe unexpected setbacks or volatility.
Interesting observation about who's in the trade. Beyond the traditional military hardware tanks, planes, where is the focus shifting within this increased defense spending trend?
This is a key point. They really highlight the emergence of digital defense as a major area of investment. So this isn't just about tanks and grenades anymore. It involves substantial spending on things like cybersecurity, bolstering strategic infrastructure, and advanced border security technologies.
Okay, so tech and infrastructure.
Yeah. They estimate this broader category could account for maybe around 1.5% of a country's GDP dedicated to defense, in addition to the more traditional military investments, which might be around 3.5% of GDP.
So adding up to roughly 5% of GDP potentially directed towards defense and these related strategic areas.
Exactly. And they really emphasize that 5% of GDP is an enormous level of investment. It's basically a wartime level of spending commitment that very few nations are actually undertaking right now. They use the example of the Danish Prime Minister recently outlining their defense spending breakdown to illustrate this kind of split between direct military and this broader digital strategic infrastructure category.
So a significant chunk of this massive spending is flowing into technology and infrastructure. Is there a specific example of a company they mentioned that might be benefiting from this trend?
They feature a German company they refer to pseudonymously as Jonas. They highlight its strong recent performance, which they link explicitly to this growing focus on digital defense. They present Jonas as an example of a European company with capabilities in digital infrastructure and cloud services that seems really well positioned to benefit from this shift in spending priorities.
So it's not just the usual U.S. defense primes. European digital infrastructure companies are definitely relevant players here too.
Yeah.
They also mentioned Palantir in this context, didn't they?
Yes, they bring up Palantir, sharing the detail that the Trump administration apparently provided Palantir with the means to build what they describe as an all-in system on the U.S. population.
An all-in system. What does that imply?
It implies a pretty comprehensive data aggregation and analysis capability, likely involving vast amounts of information. And they expect similar large-scale orders for European companies operating in this digital defense and data integration space, as governments increasingly prioritize having this kind of capability.
That concept of an all-in system built on population data.
Yeah, that sounds quite significant, maybe even a little unsettling. For the listener, how might increased spending on digital defense and strategic infrastructure present new opportunities or perhaps risks that you should be aware of?
Well, from an investment perspective, it clearly flags cybersecurity, data analytics, and critical infrastructure technology companies as potential beneficiaries of large government contracts. Are these sectors you've considered? Are companies like the one they call Jonas on your radar at all?
Right.
But from a broader societal viewpoint, the development of these comprehensive all-in systems using advanced technology, it raises really important questions about data privacy, government surveillance, and that tricky balance between security and civil liberties risks that are kind of inherent in this technological shift.
It's a powerful reminder that defense spending in the 21st century looks very different from the past.
Definitely. Okay, moving from geopolitics back to the topic of fiscal policy. Raoul Pal's team offers their take on deficit reduction efforts in the U.S.
Right. They provide an assessment of recent efforts towards deficit reduction, which they somewhat humorously dub the Doge Project.
The Doge Project, okay, their tongue-in-cheek label for deficit reduction.
Yeah.
What's their assessment of its effectiveness? Is it working?
Their view is pretty stark, actually. While measures like increased tariff revenue might help marginally, they state unequivocally that these efforts are not large enough to alter the overall trajectory of the U.S. deficit. They state plainly that the U.S. deficit is still moving in the wrong direction, meaning it's continuing to grow unsustainably, despite these smaller countermeasures.
So any talk of saving or austerity just isn't keeping pace with the spending side.
Exactly. They characterize the current U.S. administration's approach as firmly in outgrowing mode. They're prioritizing economic growth as the hopeful solution to the debt problem rather than being in genuine saving mode, which would require significant, probably politically difficult austerity measures.
What about that boost in tariff revenue we heard about earlier from Besant and Pomp? Doesn't that make a dent?
It helps, sure, but only on the margin. They acknowledge that April and May saw decent tariff revenue, maybe running around 2.5 times typical levels, which could potentially amount to something like $300 billion a year.
Okay.
But they immediately put that into context. $300 billion is roughly only 1% of U.S. GDP, while the current annual deficit is running around 6% of GDP. So while the tariff revenue is a positive contribution, it's, as they put it, not stopping this train. The fundamental trend of growing deficits remains firmly in place.
Right. Tariffs are just a small piece of a much, much larger deficit puzzle. They also mentioned the possibility of another piece of legislation, the big, beautiful bill. What's that about?
Yes, they note that there's discussion around this potential bill this week. Their expectation, even considering the increased tariff revenue, is that the overall impact of this bill, if it passes, will likely be a slight fiscal loosening, meaning a modest increase in government spending relative to revenue, which would actually contribute further to the deficit rather than reducing it.
So looking at the overall picture, they just don't see a realistic path to balancing the budget anytime soon.
They have a very, very blunt assessment of that prospect. They include a direct quote that calls the notion that individuals like Trump, Besant, and Musk could somehow come in and balance things utter bullshit.
Wow. Okay.
They state unequivocally that it was never really a case that was feasible given the underlying dynamics and, frankly, the political realities.
Bullshit. Yeah, there's no ambiguity in that assessment from their perspective. What are the implications of this persistent deficit trend for the bond market then?
Their view is that the bond market, particularly the long end of the yield curve, might not be fully factoring in the sheer volume of future bond issuance that's going to be necessary to fund these ongoing deficits. They're starting to see signs of higher long bond yields appearing, which they believe is a consequence of this reality beginning to assert itself. More debt usually means more supply of bonds, which tends to push yields higher over time.
So the bond market might be overdue for adjusting to the reality of government borrowing needs.
Interesting. What do they anticipate for market flows specifically in June? Any short-term shifts expected?
They anticipate a reversal of the flows that were seen late last week. Those flows involve buying bonds and selling risk assets, like stocks. For June, they expect those flows to reverse course, with money moving back into equities and out of bonds.
Why did we see that specific flow dynamic last week? Buying bonds while selling risk? That seems a bit counterintuitive given the bullish market sentiment we saw earlier in May.
Yeah, they explained this was primarily a technical move. It was driven by portfolio rebalancing, specifically because of the market performance in May. May saw what they describe as an outrageous outperformance of risk assets relative to bonds.
This created large divergences in portfolio allocations for big institutional players. They draw a parallel to the extreme market movements back in March, April 2020, when the market went from that full stop crash to a full go recovery. That period also saw massive relative performance shifts that triggered significant rebalancing flows. The recent gap between how well stocks did compared to bonds in May was similarly extreme, apparently prompting large institutions to technically buy bonds and sell some risk assets just to bring their portfolios back towards their target allocations after May's big move. It wasn't necessarily a fundamental shift in sentiment, more of a mechanical response to that performance gap.
Ah, okay, that makes sense. So that bond buying wasn't necessarily institutions getting scared. It was just them hitting their rebalancing targets after equities soared so much in May. That clarification is really important. So for the listener, how might this ongoing debate about deficits, tariffs, government spending, combined with these views on market flows, how might that impact your economic outlook?
Well, understanding that large deficits persist, that tariff revenue is kind of marginal in that context, and that the government is likely still in outgrowing mode, that provides important context for the long-term economic environment, right? What does this mean for your inflation expectations, maybe the long-term stability of government finances?
Right.
And if you are managing your own investments, being aware of anticipated short-term market flows, like this expected rotation back into equities in June, driven by rebalancing, that could potentially inform your short-term positioning or even trading decisions.
It definitely adds layers of complexity, considering both the big macro picture and these more technical market dynamics. Finally, on Real Vision, they touch on some specific investment positions and a potentially niche opportunity related to tariffs.
Yes, they state some of their own positioning based on this analysis.
What are those specific positions they mention?
They reiterate their long-standing view that they dislike the long end of the yield curve, meaning they expect yields on longer-term government bonds to continue moving higher. They also hold the view that the U.S. dollar is vulnerable and they expect a negative input for the dollar going forward.
A negative outlook on the dollar. Why specifically?
They tie this partly to geopolitics, actually, specifically the situation involving Russia. They believe that lifting sanctions on Russia could have been a crucial step for the U.S. to sort of restore trust and momentum for the dollar's role as the dominant global reserve currency.
How so?
Well, it might have encouraged countries in the global south, for instance, to resume buying dollars and U.S. treasuries more confidently. Since removing those sanctions seems highly unlikely now, they think the dollar is kind of left in a somewhat isolated position. This inability to leverage geopolitical events for dollar strength acts as a negative signal for the currency for the foreseeable future, in their view, reinforcing trends that could contribute to a weaker dollar.
So geopolitics and foreign policy decisions feeding directly into the currency outlook.
Interesting. What about tariffs? Is there an investment angle there beyond just the macroeconomic impact? You mentioned a niche opportunity.
They do highlight a specific area related to tariffs,
Yeah.
Section 232 tariffs. They explain that unlike some other types of tariffs that face legal challenges or a lot of back and forth, like reciprocal tariffs, which have apparently been repealed, appealed, and reinstated, Section 232 tariffs are currently not legally challenged and are considered much easier for a president to impose unilaterally.
Okay.
An example is the 50% increase on steel and aluminum tariffs imposed under this section. They note this mechanism could potentially be used again, perhaps adding tariffs on something like copper, for instance.
And this leads to a specific investment idea. Yes, they introduce what they call a super niche case for potentially making money on tariff arbitrage using this Section 232 mechanism. They mention that Real Vision Pro Macro research has explored this. The implication is that really understanding the legal and practical mechanisms of specific tariff types like Section 232 can sometimes uncover less obvious, maybe less crowded trading opportunities.
A super niche tariff arbitrage play. Yeah, that sounds like something that requires digging pretty deep into the policy specifics. Any other general tool they recommend investors use?
They just briefly suggest that checking institutional positioning charts can be a useful tool for investors, just to get a sense of where large, sophisticated pools of capital are currently allocated or leaning.
Okay, so for the listener, what are the specific investment positions being considered based on this Real Vision analysis, expecting higher long bond yields and a weaker dollar? And maybe is exploring something like tariff arbitrage related to specific mechanisms like Section 232 a niche opportunity you might consider researching further, perhaps starting with the source they mentioned?
Yeah, it definitely encourages looking beyond just the headlines and trying to understand the nitty-gritty details of policy implementation because Sometimes those details can unlock less crowded or specialized investment opportunities.
Fascinating how deep you can go, even on seemingly simple policy tools like tariffs. All right, we've looked at macro strategy, market dynamics, global forces. Now let's turn our attention back to that disruptive power of AI and robotics we touched on earlier, and dive even deeper into its practical implications for building businesses and the future of work itself.
Also, we take you inside a look at how AI isn't just some theoretical future technology, but is actively being used right now to enable entirely new kinds of startup workflows, pulling insights this time from a recent episode of My First Million.
Yeah, the premise here is really quite eye-opening. How someone could potentially build a $1 an hour plus startup, not by hiring a huge team of people, but by using AI agents to effectively replace roles traditionally filled by developers, salespeople, marketers, researchers, even product managers.
Wow.
It's pitched as a powerful new workflow, especially for, idea people or maybe solopreneurs who don't have vast resources.
The idea that AI agents could become your entire early stage team, that's pretty radical, isn't it? But they actually lay out a practical 6-step workflow for how this could actually happen.
Okay, replacing entire roles.
Yeah.
That definitely feels like sci-fi starting to hit reality.
Yeah.
What's the very first step in this AI-powered workflow? Finding the idea.
Step 1 is exactly that, finding ideas and identifying trends. They recommend using a specific AI tool called ideabrowser.com. This tool is designed to give you daily ideas based on emerging trends it spots online. For example, it might suggest creating an AI SEO agency focused specifically on optimizing content for large language models, something they kind of dub LLM boost.
LLM boost, okay.
And the tool itself uses AI agents to perform initial market analysis, provide opportunity scores, suggest potential business models and pricing strategies, and even assess founder fit by analyzing your skills against the requirements of that particular idea. The core message is, if you have the ability to execute, this tool can drastically accelerate that crucial first step of finding and validating a promising idea based on real-time trends.
So the AI helps you find the idea and does the initial market research and viability checks.
Yeah.
Very cool. What's step 2 then?
Step 2 is sketching out the idea. They do acknowledge this still requires a human touch, to visualize the flow or the process. They use a tool called tldraw.com, which is like a digital whiteboarding tool, to quickly sketch out things like, say, the steps a user would go through in their LLM boost quiz.
Okay, drawing it out.
And a key piece of advice here, a huge hack they mention, is that providing the AI tools with images of your sketches significantly improves the results you get from them in the later steps. Apparently, the AI can understand the visual structure better that way.
Visuals helping the AI understand the concept better. That's a neat trick. Okay, step 3, scoping the minimum viable product, the MVP.
Right. This step involves detailing exactly what the initial version of your product needs to actually do. They use an AI agent tool called Manus for this, describing it as a kind of supercharged operator. You feed Manus your business goal and your initial idea, and it basically acts like an AI product manager.
Okay.
It'll ask clarifying questions to help refine the concept, it'll offer critiques of the idea's potential weaknesses, and then it builds out a detailed project plan with a comprehensive to-do list. And crucially, it can also generate necessary content for the MVP, like the actual quiz questions needed for the LLM Boost service, or maybe the prompt tests required for interacting properly with LLMs.
So it breaks down the big idea into actionable steps and even generates content needed for the product itself. They also mentioned a hack here about prompting the AI, didn't they?
Yes, they highly recommend using a technique called persona prompting with any LLM, including Manus. You basically ask the AI to pretend to be a specific expert whose perspective is relevant, like act as Warren Buffett giving me investment advice, or act as a McKinsey consultant critiquing my business plan.
Oh, clever.
This forces the AI to adopt a specific style, knowledge base, and critical framework, and it often yields much more insightful and targeted results than a generic prompt. They do, however, include an important disclosure about Manus being a Chinese tool, advising users to be cautious about feeding really sensitive or proprietary information into it.
Yeah, that's a very important caveat to keep in mind. So Manus provides the plan and the content. Step 4 is what they call vibe coding the prototype. What's that?
This is where you actually build the initial version of the product. They use tools like bolt.new, which they describe simply as English to software.
English to software.
Yeah. You take the detailed prompt, the plan, and the content generated in the previous steps by Manus, and you feed it into bolt.new, or maybe similar tools like Lovable, Cursor, or Windsurf. These tools can then generate functional software components like working landing page for your service, the marketing copy for that page, the interactive flow for the quiz itself, even adding necessary elements like a privacy policy note.
So you describe what you want the software to do in plain English, and the tool actually generates the code. That sounds incredibly fast compared to traditional coding methods.
It dramatically reduces the time and the level of technical expertise needed for that initial build. They describe using this exact approach to build the core of their LLM Boost business. A quiz provides a report, which then leads to an offer for a service, priced maybe at $3,000, $5,000 a month, to help companies optimize their online presence for AI search. And the service itself, they explain, is based on about 80–90% traditional SEO practices. But it also involves creating specific tools or software that generate high LLM signals, basically making content more discoverable and understandable by these large language models. They really emphasize the speed potential, saying you could theoretically hook up the API for a service like this in under an hour using these tools.
On the functional prototype and even connecting key components in potentially under an hour.
Yeah, that's truly disruptive speed. Step 5 is vibe marketing and automation.
Right, getting customers. For this, they use another AI agent called Lindy.ai to automate significant portions of the customer acquisition process. They describe a workflow. You post content on platforms like Twitter or LinkedIn related to your business idea.
Okay.
Then Lindy tracks engagement with that content, likes, comments, retweets. It then uses publicly available data to enrich the information about the people engaging. It qualifies those leads based on criteria you set beforehand. It finds their contact information. It notifies your sales team, maybe via Slack, about the qualified lead.
And crucially, it can trigger personalized email or text outreach automatically, or based on a simple human action, like a salesperson just putting a heart emoji on the Slack notification for that lead.
Automating lead generation, qualification, data enrichment, and personalized outreach. I mean, that cuts out a massive amount of manual sales and marketing effort.
They suggest this kind of workflow has the potential for millions of dollars in saved costs or maybe new revenue generation compared to traditional manual sales follow-up processes, especially for high-ticket B2B services where timely and personalized outreach right after someone shows initial interest is absolutely critical.
Millions saved or gained just through automating follow-up with AI. That's huge. Okay, the final step in their workflow. AI agent, product management, and scaling.
Right. Once you have your initial service or prototype validated and maybe making some money, step 6 is about scaling it up, potentially transforming a service business into a full-fledged tech product. They actually revisit ideabrowser.com for this. You feed in your existing service idea, like the LLM SEO service, which they analogize to an AIS.
Okay.
The AI analyzes the market landscape again, comparing it to existing players like Ahrefs or SEMrush, and it suggests scaling strategies. This includes structuring your offer differently and proposing new pricing models, perhaps shifting to a software as a service SaaS model like $99 a month.
But moving from a relatively simple service to a complex tech product, like one that actually crawls the web for SEO data, that traditionally requires significant expensive development work. How does AI help with that scaling?
They stress that you don't just revert to the slow, traditional development methods. You essentially repeat steps 1 through 5 of their workflow, but now you're using more technical English to software tools. Tools like Bolt or Lovable might handle the front-end user interface aspects, while tools like Cursor, Replit, or Windsurf are more geared towards the heavy technical back-end scaling required for a true software product. They definitely acknowledge that the scaling is harder than building the initial prototype, but they argue it's still dramatically faster than building from scratch without AI assistance. It's about using AI to accelerate the entire product development and management lifecycle itself.
So AI augments developers and product teams, enabling them to build and scale much, much faster. They also mention templates as a resource.
Yes, they suggest exploring resources like Lindy and Gumloop's templates. Apparently, these often contain thousands of potential $1 malice plus business ideas, many of which are built around existing AI-powered workflows, like an AI medical scribe was one example given. The idea is you can often take these proven workflow templates and productize them relatively quickly using the AI tools they discussed.
Leveraging existing AI workflows and turning them into marketable products. Yeah, that's a clever shortcut. What is their overall message about AI proficiency for individuals and leaders in this new world? Is it something you can just hire for?
Their strong belief is that AI proficiency, the ability to actually understand and effectively use these tools, is not outsourceable. Leaders and individuals alike, they argue, need to learn it themselves and teach it within their organizations. The speaker himself says he stays updated by being a self-proclaimed nerd, following key people on Twitter, which he sees as the new trades or industry publications, actively playing with the tools to understand their capabilities firsthand, and learning in public by sharing his findings and experiments.
Learn it yourself, get hands-on, share what you learn. Makes sense. Finally, they share one more example of an insane AI workflow using Lindy.ai, this time for negotiation.
Yeah, this is a really striking example of automation. You can apparently train a Lindy AI agent on a knowledge base, maybe something like a Notion document that contains your specific business rules, including your negotiation parameters, like what's the minimum acceptable discount, what's the maximum flexibility allowed, etc.
Okay.
Then, if a customer emails asking for a discount, the AI can automatically process that email, check the rules in the knowledge base, and respond to the customer, attempting to negotiate within your predefined boundaries, all without any human intervention needed in that loop.
An AI agent automatically negotiating prices based on predefined rules. That's pretty wild and, yeah, has enormous implications for sales, customer service, everything. So for the listener, could this AI workflow from idea generation to marketing automation, and even negotiation, could it apply to your current job? Or maybe a side hustle idea you might have been thinking about?
Yeah, think about the manual steps you take today, or maybe the barriers that have stopped you from starting a business. Are there parts of this 6-step workflow where AI agents could automate or significantly accelerate things for you? How might this change your interactions with businesses going forward, knowing that you might increasingly be interacting with an AI agent handling tasks like lead qualification or even negotiation? And critically, stepping back, is AI negotiation something you would personally trust or feel comfortable interacting with as a customer?
It definitely challenges our traditional notions of business processes and automation, that's for sure. Now let's look at AI's impact from yet another angle, focusing on its broader effects on the job market and the absolutely crucial skills needed to navigate this changing landscape. Pulling insights now from Mark Meldrum.
Right. Mark Meldrum provides an analysis that really tries to tie recent economic data points directly to the potential impact of AI on the economy and, maybe more importantly, on specific jobs and the skills required for humans to remain relevant in this new era.
He starts with a quick look at some key economic indicators, setting the stage.
Yes, he just quickly notes the current data points. Long-end bond yields are slightly down. The PCE inflation number came in at 2.1%, and there was that recent jump in jobless claims, up to 240,000. He then highlights a statistic he finds particularly concerning, a significant predicted rise in U.S. graduate unemployment. He forecasts it's jumping from 4.6% in 2024 to 5.8% in 2025.
Wow, a projected 1.2 percentage point increase in graduate unemployment in just 1 year.
Yeah, that's a worrying sign, especially for recent college leavers. He sees this data as potentially giving the Federal Reserve justification, maybe even permission, to cut rates.
He believes that the combination of the PCE inflation number being pretty close to the Fed's target and this uptick in both overall jobless claims and specifically graduate unemployment, that provides the necessary data signals for the Fed to justify interest rate cuts if they wanted to.
However, he doubts they'll actually act immediately. Maybe they feel the economy is still perceived as resilient, or perhaps the cost of waiting to be absolutely sure is low in their minds. But he argues that the data, from his perspective, is starting to provide the permission structure for potential rate cuts down the line, even if he remains critical of the Fed's long-term forecasting on things like interest expenses and debt sustainability.
So the data might support cuts, but other factors, maybe perception, could delay action. Okay. How does he view the overall AI ecosystem in terms of who wins and who loses in this transition?
He sees some pretty clear winners in the AI infrastructure layer. Companies providing the specialized chips needed to run AI, the companies building the massive data centers to house all those chips, and the energy providers who have to power those incredibly energy-hungry data centers. These are the fundamental building blocks.
Makes sense?
The AI development companies themselves, the ones actually creating the large models like GPT-4 or Claude, he sees those as more of a question mark. He wonders if the immense cost of building these frontier models will naturally lead to just a few dominant players, creating something close to natural monopolies. But he's clear that the suppliers to these AI companies and, crucially, the users of AI technology are definite winners. And consumers, as the ultimate users who benefit from increased supply, also gain in his view.
Consumers gaining from increased supply. That brings us right back to that deflationary potential we touched on earlier with Friedberg's comments.
It does, and Meldrum dives into this head on. He argues that many businesses discussing AI's productivity boost are making a significant, potentially flawed assumption. If one company uses AI to double its output, that's great for that single company. But if all of its competitors also double their output using AI, the market is suddenly flooded with massively increased supply. Unless there's a commensurate surge in consumer demand, which would likely require dramatic increases in wages or employment, the market simply cannot absorb all that extra supply at current prices.
So if everyone doubles their output, prices basically have to fall drastically just to clear the market.
That's his logical conclusion. He sees AI, or what he prefers to call artificial cognitive domain emulators, or CDEs, we'll get to that term. He sees them as massively deflationary for precisely this reason. The productivity gains are potentially so large and the potential for increased supply so vast that it will exert powerful downward pressure on prices unless demand fundamentally shifts in a way he doesn't see happening automatically.
Massively deflationary. Yeah, that's a strong term with huge economic implications. And it potentially conflicts with that view of asset inflation driven by debasement and government support we heard earlier. Interesting tension there. He also identifies specific industries that he believes are facing obsolescence or at least major disruption due to AI right now.
Yes, he lists several areas where AI's current capabilities are already highly effective, putting those sectors at risk. Standardized test preparation, like SATs or GMATs, because the content is relatively stable and AI can master it pretty easily. Coding and app development, he actually makes a bold prediction about the decline of Google search for code within about a year, suggesting AI tools like Perplexity are already superior for many coding tasks. Graphic design, where sophisticated results are increasingly possible just via prompting AI tools. Autonomy drivers, especially for predictable routes like heavy Class 8, long-haul trucks. And certain levels of tutoring, particularly K-12 and some basic university-level help.
Those are very specific, concrete examples of where AI is already capable of performing tasks that humans used to do or are currently doing. You mentioned his preferred term, artificial cognitive domain emulators or CDEs. Why does he think that's a better term than just AI?
He argues that CDE more accurately describes what these systems actually do, and crucially, it highlights their limitations. He uses Bloom's taxonomy of learning as a framework.
Bloom's taxonomy, okay.
Yeah, this taxonomy ranks cognitive skills from lower levels, like remembering facts, understanding concepts, applying knowledge up to higher levels, like analyzing information, evaluating arguments, and creating new things. He points out that current CDEs are exceptionally good at the lower domains, recalling vast amounts of information instantly, understanding patterns in data, applying rules consistently, but they are significantly less adept currently at the higher domains that require deep critical analysis, nuanced evaluation, and truly novel original creation. Calling them CDEs clarifies that they emulate specific domains of human cognition, not the full spectrum of what we think of as intelligence.
That's a really helpful distinction, actually. It helps clarify where AI is incredibly strong and where humans perhaps still have a significant edge. And he uses this CDE framework to critique how AI companies themselves are sometimes being valued.
He sees a real inconsistency, particularly among finance professionals. When you value a traditional business, you always look to the future, right? The value is based on forecasting its future earnings and cash flows. It's worth what it will do. Right, forward-looking. But with AI companies, he observes many people fixating on their current limitations, constantly saying, oh, it can't do this yet, or it still makes these kinds of errors. He argues this is fundamentally the wrong way to look at it. To properly value AI's potential impact, you must forecast its incredible pace of improvement and its likely future capabilities, and then discount that potential back to today, just as you would with any other high-growth investment.
Don't value AI based only on its current state, but on its potential future trajectory. Makes sense. So given the current state of these CDEs, what's his estimate for their impact on the U.S. job market in the near term?
Based on the current capabilities of AI, just in those specific sectors he identified as highly vulnerable, he estimates roughly a 2% increase in unemployment in the U.S. That translates to approximately 3.22 million jobs lost over the next, say, 12 to 24 months. He references reports like the one from Signal Fire, which shows a significant reduction in tech hiring of new graduates, as supporting evidence for this specific displacement trend already beginning in certain sectors.
3.2 million jobs potentially displaced relatively quickly in the U.S. He contrasts this with some broader, maybe more optimistic global reports, right, about job creation versus destruction.
Yes, he notes reports like the one from the World Economic Forum, which often take a global view, and might suggest that AI could ultimately create more jobs than it destroys worldwide, perhaps benefiting poorer nations by increasing access to education and information. But Meldrum really emphasizes that the U.S. context, based on data like that Signal Fire report, seems to show more immediate volatility and job displacement concentrated in certain sectors, particularly impacting those new graduates trying to enter the tech field right now.
So the global average might hide significant disruption and pain in specific regions or industries like the U.S. tech sector. He also shares some forecasts on how tasks performed by humans versus technology will shift quite dramatically just by 2030.
Yeah, the forecast he presents is pretty stark for the near future. It suggests that the proportion of total work tasks performed predominantly by humans is expected to drop significantly in just 5 years, from 43% today down to only 29% by 2030.
Wow, from 43% to 29%.
Conversely, tasks performed predominantly by technology are expected to jump from 26% today up to 38% by 2030, and tasks performed by a combination of humans and technology-augmented tasks are projected to increase only slightly from 30% to 33%.
That's a huge swing away from purely human tasks towards technology and away from augmentation towards pure tech in a very short time frame.
It shows a clear displacement effect, and this ties directly back to his deflationary argument. If technology takes over more tasks and productivity surges, that massively increased supply, without a proportional increase in demand driven by significantly higher wages or employment, puts powerful downward pressure on prices.
So if AI or CDEs are mastering those lower cognitive domains and taking over more and more tasks, how can humans possibly thrive in this rapidly evolving job market? What's the path forward?
This is his crucial takeaway, the core of his message for individuals. To stay relevant and valuable in an AI world, humans must move up Bloom's taxonomy. They need to focus intensely on developing and operating in the higher cognitive domains. Analyze, evaluate, and create. It's no longer going to be enough to just know facts or follow procedures, because CDEs excel at that. It's about how you process information, how you judge it, and how you originate new ideas or solutions. He stresses that developing critical thinking and reasoning skills is absolutely essential, particularly in fields like finance, where complex analysis and nuanced judgment are required.
Moving to higher ground, cognitively, as he puts it, what specific critical thinking skills does he identify as being most important to cultivate?
He outlines several key skills: the ability to identify and rigorously evaluate arguments, breaking them down into their core premises and conclusions, spotting how things are being framed; the ability to recognize logical fallacies that undermine valid reasoning; applying analytical frameworks systematically to dissect complex problems; and rigorously evaluating evidence, distinguishing reliable sources from unreliable ones. He uses the MicroStrategy case study as an example of potentially putting out misleading information, and the Beyond Meat case study as an example of building arguments on faulty premises to illustrate these points.
Using real-world case studies to show how these critical thinking skills are applied, or perhaps sometimes ignored, leading to bad outcomes. What about our own internal biases, cognitive biases?
Recognizing and actively mitigating our own cognitive biases is also absolutely crucial. He even suggests that AI itself can be a tool to help with this. For example, you can use an AI to counter your own confirmation bias by specifically asking it to prove me wrong about your strongly held beliefs or investment conclusions. Developing strategies to identify and reduce the impact of biases like confirmation bias or anchoring is essential for making better decisions in this increasingly complex, information-rich, AI-influenced world.
That's fascinating, using AI not just for productivity, but as a tool to actively improve our own thinking processes and counteract our inherent blind spots.
Exactly. The goal he advocates for is augmentation, using AI to enhance our own higher cognitive functions, not simply allowing ourselves to be replaced by lower-level emulation. By actively cultivating these skills, analyzing, evaluating, creating, recognizing biases, you position yourself on that crucial higher ground that is less susceptible to direct AI displacement.
Okay, so for the listener, how might AI's impact on jobs, and particularly this strong push towards developing higher cognitive skills, how might that affect your career path or your decisions about learning and development going forward?
It's a pretty stark call for continuous learning and honest self-assessment, isn't it? Are your core job tasks currently concentrated in areas that AI is rapidly mastering those lower cognitive domains? If so, what steps can you proactively take now to shift your focus towards tasks requiring more sophisticated analysis, evaluation, or creativity? And importantly, how can you actively develop the critical thinking skills needed to navigate this AI-driven world and ensure you are operating on that essential higher ground? Viewing AI through that lens of CDE's artificial cognitive domain emulators can really help clarify where its current capabilities likely end and where uniquely human skills remain paramount, at least for now.
It really emphasizes that the future of work isn't just about understanding AI technology itself, but maybe even more about deepening our fundamental human cognitive abilities.
Precisely. It feels like an urgent call to, well, level up our own thinking.
This deep dive has taken us through a really complex and interconnected landscape today. We've heard perspectives suggesting asset markets might be setting up for further gains, perhaps despite potential summer turbulence, driven by those policy tailwinds and robust retail buying captured in frameworks like 42 Macro's Paradigm C and Pompliano's Savers Are Losers
Right.
idea.
A kind of momentum view.
Yeah. And then we've also explored the absolutely accelerating and potentially massively deflationary force of AI, which could fundamentally reshape the cost of living and the job market, automating tasks at an incredible rate and requiring humans, as Meldrum argues, to move to higher cognitive domains. And layered on top, we saw differing views on the effectiveness of policy tools like tariffs and deficit reduction in the face of these massive government spending needs.
It really paints a picture of momentum in asset markets sort of colliding head on with the disruptive, maybe deflationary force of technology, all playing out against a backdrop of persistent fiscal challenges and ongoing geopolitical shifts.
Oh,
It's
wow.
complex.
It certainly is. Which brings us to a final provocative thought for you, the listener, to consider. In a world where AI is rapidly mastering the lower levels of thinking and potentially driving down costs and maybe even wages through immense productivity gains and supply increases, is the traditional investment playbook of simply buying the dip in risk assets a strategy often predicated on currency debasement and government support? Is that truly sufficient anymore? Or does the sheer scale and speed of this technological deflationary wave demand a fundamentally different approach, both to how we invest and how we prepare ourselves for the future?
Yeah, that feels like the central tension emerging from all these different sources, doesn't it? Are the forces pushing asset prices higher the policy? The debt dynamics, are they more powerful than the deflationary job displacing potential of AI? Or is this coming technological wave so fundamentally transformative that it requires us to rethink some of our most basic financial and professional assumptions? It's a huge question.
Markets move fast. Pinpoint your next profit window and seize the moment.